Hey everyone, and welcome to this explainer. I am so incredibly excited you're here today. We are about to embark on a really fascinating dual journey. First, we're going to explore this massive, seemingly sudden explosion of humanoid robotics, and then we're going to pivot, and we're actually going to pull back the curtain on the financial gates that surround this bleeding-edge tech. So, if you've been wondering why it feels like robots just magically learned to walk yesterday, or why you can't seem to invest in the companies actually building them, well, you're in the exact right place. Let's dive right in.
To kick things off, roboticist Dr. Scott Walter completely shatters this illusion of an overnight success with this quote. He says, "We've been building this pyramid one step at a time, and it just finally we got to the step where we're like, oh, now we can put this all together." You see, when we look at humanoid robots today, seamlessly doing chores or working on factory floors, it looks like magic, right? Like it just materialized out of thin air. But it isn't. It's the result of decades of invisible, painstaking engineering labor. The pyramid has literally been under construction for a really long time, and we are just finally reaching the top.
Okay, here's a quick roadmap for our explainer today. 1. The 40-year robotics wait. 2. More of X paradox. 3. Tech convergence. 4. Factory floor reality. 5. Investment gatekeepers. And 6. Democratizing physical intelligence. All right, Section 1. The 40-year robotics wait. From offline programming to sim to real.
So, back in 1985, engineers at companies like DEP Robotics were trying to solve this thing called robot offline programming. Basically, they'd create this virtual 3D world, put a digital robot in it, and try to teach it what to do before they ever moved the program into the real world. Does that sound familiar? Because today, 40 years later, we call this exact same concept sim-to-real training, or reinforcement learning. The fundamental concept hasn't actually changed since 1985, it's just that our tools have finally caught up to the vision.
Moving on to Section 2. Moravec's paradox explained. Why easy is hard.
Okay, Moravec's paradox is this absolutely fascinating observation. The tasks that are easy for a machine to do are incredibly hard for a human, and tasks easy for a human are, well, incredibly hard for a machine. Just think about it for a second. A computer can calculate super complex calculus in a literal millisecond, right? That's incredibly hard for us. But folding a towel, or just walking across a messy living room, we do that without a second thought. But for a machine, that is an absolute nightmare of edge cases in physics.
And human walking brilliantly illustrates that exact point. Walking is essentially an inverted double pendulum problem. We completely take it for granted because our brains just handle it in the background. But from an engineering perspective, it's a massive computational challenge. Actually, this is exactly why the original Segway way back in 2001 was such a monumental breakthrough. It wasn't really about the scooter itself, it was the fact that dynamically balancing on two wheels was a huge step in solving the locomotion problem for machines.
All right, Section 3. The technological convergence. Actuators meet intelligence.
Now, none of these breakthroughs happened in a vacuum. The real reason we're seeing an explosion in humanoids right now is that these very specific technologies all matured together at the exact same time. It's like a giant puzzle coming together. Inertial measurement units, or IMUs, got tiny enough to fit practically anywhere. Control logic loop speeds became ultra-fast. We finally have physical hardware actuators that can run for days without just burning out. And, maybe most crucially, advanced AI neural networks matured enough to actually serve as the brain.
4 years. That represents the age of Figure Robotics, which is one of the leading humanoid companies in the entire world right now. Just think about how wild that is for a second. After decades of slow, grinding foundation work, and mostly because of that technological convergence we literally just talked about, a company can go from completely non-existent to producing incredibly capable humanoid robots in just 4 years. The acceleration here is absolutely staggering.
Which brings us to Section 4, the factory floor reality, why robots fail in legacy environments.
This is a stark comparison, and it's super vital to grasp. People often ask, well, Amazon warehouses are completely automated, so why can't we just do that everywhere? Well, Amazon is what we call a greenfield. The system dictates absolutely everything. Standardized boxes, standardized UPCs. The environment is perfectly controlled. But legacy auto factories, they're the exact opposite. You can't just tear the whole factory down to start over. The robot has to adapt to a rigid, existing line filled with totally unpredictable subassemblies. And here's the craziest part about those legacy factories. Human adaptability actually masks underlying flaws in the manufacturing process.
In early automotive automation, companies found out that human workers were essentially covering up bad metal stampings by, wait for it, using 2x4s and sledgehammers to physically whack subassemblies into place. I mean, can you imagine? Humans can force a bad part to fit, but a rigid robot, it cannot. If a part is off by even a millimeter, the robot fails. So, bringing in robots doesn't just automate tasks, it brutally exposes every single quality control failure upstream.
Section 5. The investment gatekeepers, locked out of pre-IPO growth.
Now, while the physical tech hurdles are finally being solved, there's a massive financial wall blocking the general public. Retail investors, everyday people, we can't just go buy stock in private robotics companies like SpaceX or Figure. The garden is entirely gated. You have to be a qualified investor with a massive net worth. You gotta be willing to write incredibly large minimum checks. The deals are often funneled through confusing, opaque special purpose vehicles or SPVs. And of course, these high-growth opportunities are strictly excluded from your standard 401k or retail brokerage accounts.
So why does that actually matter? Because the biggest value creation for high-growth tech companies happens pre-IPO, before the public can even invest. By the time an exciting robotics company actually rings the bell and goes public, the steepest part of its growth S-curve is usually already over. The massive early multipliers were captured purely by institutional wealth, while the general public is left with a slower, more mature growth phase.
Let's look at Section 6, Democratizing Physical Intelligence, a new financial mechanism.
Okay, let's act as a bit of a translator for these financial mechanics. The source material outlines a closed-end fund under the ticker BOT. Now, unlike a standard ETF that just holds public companies, this holds a basket of private, illiquid robotics companies. In a traditional ETF, if people want their money out, the fund has to sell underlying stock. But this is a closed-end fund listed on the NASDAQ. That means capital is raised to invest directly in these private companies to fuel their super expensive R&D, all without the daily pressure of redemptions dictating selling. To really understand how this works, you have to understand NAV, or net asset value. This is the total calculated valuation of all the underlying private startups the fund actually owns. It determines the true baseline value of a single share. So when you look at the public share price on the stock market, you're always comparing it to the NAV to see if you're trading at a premium or a discount to what the assets are actually worth on paper. So how does this all build into an actual growth engine? Well, step 1, the fund shares trade at a premium above the NAV on the open market. Step 2, because of that premium, the fund can issue new shares. Step 3, that generates new capital, which they immediately deploy to invest in even more private robotic startups. And finally, step 4, because they issued new shares at a premium, the overall baseline NAV per share actually increases. So trading at a premium isn't a bad thing here. It's literally the exact financial engine that allows the fund to acquire more companies and expand the pie for everyone involved. Which leaves us right here. We've traced this incredible 40-year journey from the frustratingly slow days of early programming to the rapid convergence of modern AI and hardware. We've seen the very real hurdles on the factory floor, and we've decoded those financial gates that have kept the public out of pre-IPO growth. The tipping point has officially arrived. The only question left is, now that the robotic tipping point is here, are you ready for the physical intelligence era? Thanks so much for joining me on this explainer. Keep learning, and I'll see you next time.